Okay, good morning and welcome back everyone to our Monday morning trade ideas session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And we kick off this week with, again, the S&P 500 and the NASDAQ 100 once again continuing to print new all-time highs last week. We actually had a pretty positive week overall in terms of data, both economic data and data coming out of the earnings announcements. And probably the only thing that at the moment still concerns us a little bit is really where the 10-year yields have remained. They remain fairly elevated around that 4.5% level. You have the 30-year, last week going above 5%. So interest rates have remained relatively high, which speaks to more of a view on the Federal Reserve, with the relatively positive data that we saw last week. The chances of the Fed keeping rates the same in September rose by a pretty significant amount. So bond markets are pricing in now a higher probability that rate cuts will likely get further extended out from, right now, which is September is meant to be the first rate cut. That's really the biggest thing in the way, or rather a headwind right now for equities. Otherwise, the short-term stuff have seemingly turned a little bit of a corner here. Now, it's not quite enough to say, a week of economic data and earnings is enough to turn around kind of the overall decline in economic activity that we've seen over the last 3 to 4 months, but we are starting to see some early signs of improvement, and equity traders are really taking that to full advantage. Especially when you combine it with sort of a little bit of volatility that we saw here last week with regards to whether or not President Trump can fire Chairman Powell, and the sort of reversal around that, and then also the blanket roughly 10 to 15% tariff rate that's going to be applied to roughly 150 different countries, I think avoid some of the worst case scenarios that some investors were concerned about, and that kind of cleared the way for equities to rise at the end of last week. So a lot to look at here this week. This week is also a big week in terms of earnings announcements. You have tech starting to report here. You have Alphabet, Tesla, Intel reporting later this week. You also have Coca-Cola, but this is really where earnings season kicks off into full gear this week. Last week, like I said, earnings overall have been largely positive. Delta was positive. The banks largely were positive in terms of their views for the second half of 2025. And, again, that's given equities sort of the confidence to break out here and continue to trade towards those all-time highs. So we'll take a look at kind of our ideas here in a few minutes, but from a broader picture perspective, like I said, the S&P 500 continues to move higher here. We've broken out here above the 610 level here on SPY. And any pullbacks here to this particular level maintains a bullish view here on SPY. It would have to break below 610 for trends to start looking like they were going to reverse or neutralize. Same thing here on the Qs. We've broken out here above that call it 540 level here on the Qs. We've continued to push higher here. There are some signs of exhaustion here as you see higher highs in price, no longer confirming higher highs in momentum, which certainly adds to the potential for at least a bit of a pullback or some sort of consolidation. IWM breaking out to new relative highs, not all-time highs, but same type of divergence that we're seeing here. So starting to get higher chances of what is likely going to be some consolidation ahead after what is one of the strongest recoveries in equities in the history of the S&P 500. And one thing to note here is the RSP, the equal weight S&P 500 index over the past couple of weeks now have started to stall. So participation on the particular rally here has also started to slow down here a little bit as well. So this is something to also be aware of in regards to, what percentage of stocks are actually participating on these new all-time highs, and that number is starting to lower. Only about 60% of all S&P 500 stocks are trading above its 20-day moving average. I'm sorry, 200-day moving average, which is relatively low considering how long the S&P 500 has been making new all-time highs for the past few weeks. So again, broad participation overall, while improving, that improvement has slowed down and stalled a little bit here. So those are some of the things I think we need to be conscious of and aware of as we look at this rally. Now that the S&P 500 has rallied over 30% off of those April lows, just how far can a rally go before you see some level of consolidation or pullback, which overall is healthy for the markets. We just haven't seen that here in quite some time. So, if you look at the bond market, the high yield corporate bond market, while pulling back a little bit here over the last couple of weeks, have also started to accelerate a little bit more here to the upside at the end of last week. So confirming that, the credit market, the bond market is also relatively positive, providing a buy signal or a risk on signal here for equities. But like I said, it's really treasuries that's kind of spoiling the party a little bit with the sell-off here over the last few weeks, where we've seen, like I said, the 10-year yields kind of settle in around that 4.5% level, and that 30-year yield closing at about 5% here at the end of last week, basically near 52-week highs, reflecting the fact that bond markets do not anticipate a imminent cut here in interest rates, certainly not in July, and September is looking more and more questionable. So while investors were kind of hoping for that rate cut here in September and looking at that as an opportunity for markets to kind of continuing to move higher here on the back of lower interest rates, I think the bond market is telling us potentially not so fast, take it easy. The concerns that the bond market has had with regards to the sustainability of, $36 trillion of debt that's continuing to grow, which is, again, one of the things that President Trump campaigned heavily on, was his administration's ability to reduce that debt load. At the moment, his big, beautiful tax bill is not necessarily going to be the thing that's going to move the needle on that. Tariffs potentially. So we'll see here, in the next couple of months as to what tariff revenue look like. But tariff revenue is not going to close the gap with regards to, the $36 trillion worth of debt. The bond market, I think, is looking for a more aggressive solution in reducing that overall debt load. And I think going forward, this is always going to weigh on equities, even if there are periods where the bond market or equity market seemingly kind of shrug off that concern or risk. I think we're going to continue to get reminders from the bond market that is an issue. And I think that's probably the biggest downside risk that I see here with the VIX, below 17, and just sort of the complacent nature that the equity markets have been trading at over the last few weeks, that I do think presents an opportunity for investors who are looking to buy tail risk. So if you look at buying out of the money, SPY put spreads as a way to hedge against some of that downside risks, those are some of the ways that you can, in a very cost-effective way, look at having a little bit of a hedge here against spikes in volatility or potential pullbacks here in equities. So with that, let's take a look at the trade ideas here for the week. We've added 2 more bullish ideas here this week with Merks and Pinterest. We'll take a look at each one of those and our other trade ideas here at the moment. So Merks is the one that we added here this week. So Merks, as you can see, recently, the stock has been an underperforming stock, but basically since sort of the beginning of June, the trend quality has improved substantially here, potentially here to the upside. So we've continued to have a series of higher highs and higher lows, and we've kind of had multiple pullbacks here to this rising trend line. And that's exactly what we got here at the end of last week. So we had a very similar setup here in Alphabet a few weeks ago that we took a bullish position on, and we're looking at the same one here for Merks. As you can see, it trades at a pretty healthy discount to the industry, 9 times forward earnings versus 12. So you're looking at about a 25% discount relative to its peers. And if you look at growth expectations, it's expected to grow earnings by a pretty healthy clip. Revenues coming in just slightly above industry, but net margins is really where Merks exceeds substantially. So I think for those, just on the margins alone, Merks deserves to trade at a multiple that's close to around 12 times forward earnings. Versus the 9. And I think this presents the upside opportunity to the $90 price target, which I think is a really conservative price target here to the upside for a move higher here in Merks. Pinterest. We've liked Pinterest here since the earnings last quarter. It was actually one of our earnings navigator trades last quarter. And the stock has just continued to rally since that. And it recently kind of consolidated a little bit and just started to break out here again here to the upside. Our upside target when the stock currently trading at 37 is $50. And if you look at the valuations, we're trading at 21 times forward earnings, which is a little bit higher than the industry. But if you look at growth expectations, we're coming in quite a bit ahead of the industry. Net margins here. Now, these net margins are a little bit deceptive because this basically came from 1 quarter of tax revenue that drove margins substantially higher here. So this is one that I'm not particularly the margin on this particular one, I don't particularly think is the most accurate number, but that is what is stated at the moment as the net margin. And I think that's something that we need to just be cognizant of. Now, KKR was one of the stocks that we added to our list here last week, trading at 28 times forward earnings, which is certainly high for the industry. But if you look at kind of growth expectations, they far exceed the industry. So for those reasons, that's why KKR is on our list here to the upside. Our upside target is 165. The stock's currently trading at 145. Block, this is one that we've added here a few weeks ago. The stock has really started to accelerate a little bit here to the upside. So it's a great time that we added it. As you can see, it's trading at 16 times forward earnings. So a pretty heavy discount relative to the industry, even though we're expected for it to see growth that's substantially faster than the industry and it's more profitable. So for those reasons, XYZ or Block is a bullish trade idea that has really started to play out nicely. This kind of inverted head and shoulders or cup and handle, however you want to call this particular formation that's broken out here to the upside, came back to retest, and we're looking for that continuation higher here to our $85 upside target is well on its way. Norfolk Southern, this is a railroad stock that we recently added to our list, basically on a pretty strong trajectory here to the upside. As you can see, that trend quality really improved here back here in May. We added this stock here when it kind of broke out here above this 240 level here. And this stock has really started to take off recently and really take off in the last couple of days. As you can see, Norfolk Southern trades at 21 times forward earnings, which is basically in line with the industry. Even though it's expected to grow in line with the industry, it's far more profitable. And that's really kind of what caught my eye with regards to the fact that this valuation looks relatively cheap given how profitable Norfolk Southern is as a railroad stock. We usually don't cover railroad stocks. They're not particularly in our wheelhouse, but this one really caught my eye, and our upside target here is 275. So we basically just reached our upside target here at the end of last week. So we'll look at reevaluating this and whether or not we think that there's further upside here in this particular stock, because the 275 was a conservative target here. It's basically trading at its industry average in terms of valuation, even though I think there's room for further upside given the fact that it's far more profitable than your average railroad stock. If you look at Alphabet here, Alphabet, this trade that we took on Alphabet is very similar to the Merck trade that we saw here today. Basically a stock that was in a bearish trend where the trend quality started to improve here to the upside, and then we waited for a pullback here to that rising trend line as the entry point. So that's when we added this stock here back on that pullback. The stock has not only rallied off of that, is now broken out above this 180, call it double top if you want, and it's continued to break out here above that. And the valuation continues to look quite compelling. You're trading at 19 times forward earnings, which is in line with the industry, even though we see that the growth expectations are in line with the industry. What caught my eye to Alphabet is the fact that the net margins are close to 31% when the industry is closer around 6 to 7%. So Alphabet is far more profitable than its industry, yet it trades at a valuation that's in line with the industry, which is really what sets this up nicely for our upside target here. Now we've already reached our initial upside target of 185, but our extended upside target here is filling this gap at 202. So that's what we're shooting for here at the upside going forward. So our first upside target, like I said, was 185. Now we're looking for that 200 target here to the upside here for Alphabet. And then Target, this was one that we've continued to like here for Target. Now this stock is down a little bit pre-market here. We've seen this down another 1.5% here pre-market on the downgrade that I think someone in the chat window just mentioned that the stock's down to around 101 or 102 or so. So it still remains above our $100 breakout level here. So despite the downgrade, we're still above that level. But if we break back below 100, that would be a reason to consider invalidating our view here, our bullish view here on Target. Now, my thesis here on Target is rooted in both kind of the chart improvement, right? So as you can see that we've seen a continued decline here in the stock. The stock kind of has traded sideways. As you can see, trend quality went from all red to starting to improve a little bit, and then back here in early June is then kind of when the trend quality has improved substantially here to the upside. And when you have that improvement and the stock breaks out above what was a prior resistance level, as long as it holds that resistance level, we can continue to maintain a bullish view here in the stock, especially if the fundamentals make sense. And in my opinion, the fundamentals still make quite a bit of sense. Trading at 14 times forward earnings, which is a pretty heavy discount to the industry. If you look at growth expectations, we're pretty much in line with the exception of revenue growth. And that's still probably the biggest concern that I have with the stock is just, whether or not they can turn that around. They've tried multiple things to try to turn that around. We're just not there yet. We'll hopefully get there. But if we don't, this is really where but this is really where we have to pay attention. But what attracts me for Target is really the net margins. Net margins north of 4% is about higher than 75% of the industry. Target also pays it over a 4.25% dividend yield, which is almost unmatched in its industry. So they're returning a fair amount of cash to investors because they're more profitable than their peers. So for those reasons, that's why I really like Target here from a fundamental perspective. But like I said, if we break back below 100, then I would consider that the timing on this trade did not work out. Schwab also, reported earnings last week. Strong earnings popped out here above 95, which was our initial upside target here. So we'll evaluate here. But I'm from my perspective, if you look at the fundamentals, there should be some further upside here. Trading at still 22 times forward earnings. If you look at growth expectations, they outpace the industry by a pretty wide margin, and they're more profitable. So by all accounts, Schwab, if anything, should be trading back at 24, 25 times forward earnings, which would put it well into the $100 range, the low $100 range here. So even though we've reached our initial upside target, we're going to look at Schwab potentially reaching further extended targets here to the upside, which at the moment, if you look at Schwab here trading around 95, these are levels that basically are, if I'm not mistaken, they are the Schwab's all-time highs. Yeah, so Schwab basically made a new all-time high on this move last week on earnings. So we'll see if we can break out here above this double top here. The last time it reached 95 was back here in 2022 in the middle of the pandemic craze when everyone was trading. So the fact that we're kind of back at that level and we can potentially break out above that level, in my opinion, actually opens up Schwab to be truly trading back at its real valuation, which is probably closer to 26, 27 times forward earnings. If you look at, the growth rates here and the net margins here, those are kind of really nice growth rates. So trading at 26, 27 times forward earnings would probably imply, closer to a 120 upside target. So we'll do some of that calculus and update this on our next report here on on Thursday, sorry. And then Micron, so this is a trade that, we have taken early on, when it broke out here above 90, right? The stock has really rallied since we've kind of taken that bullish position, but in the last couple of weeks, it's pulled back a little bit. And I actually think for anyone here who's missed out on perhaps Micron as a trade, maybe you missed out on that initial move that we took, this pullback here represents a really nice opportunity to get back into this particular stock. As you can see, it's trading at about 9.5 times forward earnings, which is not only a discount to the industry, but also a discount to also not only a discount to the industry, but also a discount to its sub-industry, which I think that, for those of you that have been watching this for a few weeks, you'll know that I've said this. But if you're brand new here, the 27 times forward earnings is not a fair comparison for Micron. It's a comparison for the broader semiconductor industry, but Micron operates in a fairly specific niche within semis, which are memory chips, and memory chips trade at a much lower multiple because they're commoditized. They're not particularly the intellectual property on producing them are not particularly high. So they generally trade at lower multiples. Somewhere in the 12, 13 times forward earnings is probably the high end for memory chips, but Micron has retooled their business in the last few years to focus on kind of high memory bandwidth chips, which are specifically the type of memory chips that go into NVIDIA GPU chips. Now, NVIDIA trades at 38 times forward earnings, which, if you look at kind of where growth expectations and profitability are for NVIDIA, that probably is a reasonable valuation for NVIDIA to trade at, even though it's relatively high. It's just hard for a lot of investors to buy at those types of multiples and assuming that they can, sell it at a even higher multiple. So I think for a lot of investors who want to exposure to kind of the hardware side of things with regards to the growth of AI, Micron actually represents a really interesting, more affordable way from a valuation perspective, in my opinion, to get exposure to similar upside. Because, if we continue to see the acceleration of GPU and AI infrastructure being built out here in the next few years, NVIDIA is the most obvious investment in that particular space. But like I said, it's expensive. So Micron, I think, is a more understated way to get exposure to that. AI growth rather than using kind of the most obvious ways with NVIDIA. Don't get me wrong, NVIDIA is a one that I think is very much an important investment if you believe in that theme in the long run. But this is one where I really feel that worth adding to the portfolio here as well. Next, let's take a look at some of our bearish ideas here right now. And Tesla is one that is at the forefront of our bearish view here. This is one that at the moment probably needs to be reevaluated in terms of whether the timing on this is right. We still continue to make a series of lower highs and lower highs at the moment here, but as you can see, trend has started to turn a little turn green here in one bar. One bar is not enough to see this, but our downside view here is that Tesla trading at 175 times forward earnings is just trading at basically 15 times the industry average is not justifiable with, yes, they have industry leading growth, industry leading margins, but those margins are continuing to get squeezed. Growth expectations continue to get revised lower, not to mention they continue to miss their growth expectations. So trading at a valuation that high is just really impossible to justify. Granted, this stock has traded at impossibly high valuations for a very long time, so that in itself is not a good reason to short the stock, which is why I think it's always important to reevaluate any bearish views on Tesla with the technical chart. And like I said, the technical chart at the moment still holds in terms of our bearish thesis. But if we break above that level by, closer to that 350 level, or perhaps even a little bit higher, then I definitely want to reconsider the timing on a bearish view here for Tesla right now. Walmart, this is one that, our downside target is $91. The stock has been trading range bound, call it between 91 and 100. So we're basically looking at this range bound level to kind of respect the lower bounds here. As you can see, the trend quality has really kind of deteriorated a little bit and stabilized in terms of bearish trends here over the last week or so. And Walmart trades, as you can see, at a very high valuation, 36 times forward earnings. You're talking about a valuation that's basically in line with NVIDIA, right? NVIDIA is trading at 38, 39 times forward earnings. So you're looking at a valuation close to NVIDIA. But if you look at kind of the growth expectations, we're worlds apart from what NVIDIA is expecting. We're talking about 9% expected EPS growth, 4% revenue growth. That's the same, that's in the same ballpark as Target, not NVIDIA. And then net margins of 2.75% is actually just slightly above 50% of its peers. So it's not very profitable. Growth is not particularly strong. The only thing going for Walmart is that, they've kind of reinvented kind of the business model here in the last few years with regards to e-commerce and Walmart Plus, and they're looking more and more closer to kind of a Costco type revenue stream, not quite like Costco, where it's 100%, nearly 100% of their revenue is kind of memberships and very stable. Walmart is not quite there yet. But that's one of the reasons why Walmart trades at a high multiple. But I think it's really hard to justify these types of multiples with these types of valuations with this type of growth rate. And I think that there's still some downside risks that lie with Walmart. The next one I want to take a look at here is Apple. We continue to remain bearish here on Apple for many reasons. The stock kind of continues to trade sideways here, despite the fact that the S&P 500 continues to make new highs. Apple fails to make new highs. Trend quality has kind of turned positive here a little bit here over the last couple of weeks. But despite that positive trend quality, the stock still continues to stay below 215. And I think that leads us still to agree with our overall bearish thesis that we could see some further downside here for Apple trading at 27 times forward earnings, which is pretty substantial, healthy clip above the industry. Even though if you look at growth expectations, we're now well below the industry on both top and bottom line, right? This is a stock that has always consistently for over a decade consistently outperform analyst expectations, but that really turned around here in the last 12 months. They've continued to miss on sales targets and earnings expectations. The only thing that's continued to hold up right now are net margins, but we'll likely to start seeing some downside pressure on net margins here. That's the only thing that justifies a higher multiple. But as long as growth expectations continue to decline, the outlook of Apple continues to look quite chaotic internally. The product line going forward is not particularly optimistic or what's the right word, innovative, especially on the AI front. So for those reasons, it's really hard to justify continuing to invest in Apple at these multiples. And I think we likely will have to see a little bit more contraction in the multiples for Apple before, things can start turning around and this becomes a more attractive investment for investors. And the last one I'll leave you with is T-Mobile. We've been bearish on the stock for quite some time, ever since it broke below that 250 level here. Broke down, retested it as resistance, and the stock has continued to slide since. We took another bearish position here a couple of weeks ago when it rallied here, and now we're continuing to trade lower here from there. As you can see, it still trades at 21 times forward earnings, which is basically double the industry average. Now, growth expectations do outpace the industry. Net margins do outpace the industry, but I don't particularly think that superior growth and profitability is enough to justify this stock trading at a valuation that's double the industry. And that's why I'm taking a bearish view here on T-Mobile. And as the market has kind of continued to rally to new all-time highs, stocks like T-Mobile have continued to slide. So we continue to maintain our bearish view here for T-Mobile, and our downside target is 215 on that. So with that covers our trade ideas here for the week. Like I said, this is a big week for earnings. Our earnings calendar is going to be where you want to start your research. And you can think of our earnings calendar as the stocks that you could trade, which are the ones that are in green. Those are the most liquid stocks reporting on a given day. The ones with the asterisk signs are the ones that report in the morning. The ones without an asterisk signs are the ones that report in the afternoon. And like I said, the green ones are the ones with the most liquid options. The ones in yellow are somewhat liquid. So whenever you're doing your research, you always want to start with the green symbols first. Those are the ones that you could trade. And then we have our earnings navigator, which for those of you that saw our webinar on Thursday on this particular topic, this is really where we take a look at, we do a deep dive on all the liquid symbols for a given week, and not only tell you which symbols could you trade, but more importantly, which ones should you trade, meaning where do the technicals and the fundamentals align on stocks that are going to report earnings this week, and where you have potential opportunities for those moves to be explosive moves. We're really looking for stocks that have strong relative strength going into earnings that are undervalued for bullish opportunities. And we're looking for stocks that have underperformed the S&P 500 going into earnings and are overvalued to take a bearish view on earnings. So that's our earnings navigator here. That's designed to help you understand out of a week that's reporting earnings, which ones should you trade. So every single Monday, we publish this in our Monday morning research report. So if you want access to this, take a look at the Monday morning research report that we send out to all members that you can download, and you can see it in this video here as well during your replay if you want to watch that. So with that, thank you so much here for the week. I hope that this helps you set up your broader view for the macro picture in terms of how things are shaping up with the overall economy, and then some ideas here to set you up here for the week. With that, thank you so much. I hope you have a great trading day, and I'll see you guys here next week.